This video is about the difference between traditional income statement format and contribution margin income statement format. First, we'll look at the vocabulary. Sales revenue, variable cost, contribution margin, fixed cost, and operating profit. Those are the meanings of these vocabularies. In this table, we can see that sales revenue and operating profit in both of them are the same. The expenses classified are the difference between these two types of income statement formats. Traditional formats assort costs according to their functions such as cost of goods sold, gross profit, and operating expenses. The contribution margin, which is modified, assorts to the behavior pattern, which is variable cost, variable or fixed. Understanding cost behavior pattern is the key to this concept. As sales revenue increases due to more products are sold or more services are provided, variable costs will increase proportionately, and so will the contribution margin, but fixed costs will be unchanged since they are not a function of the income-generated activity. Using traditional formats, inaccurate results could be generated when changes in activity levels are being considered, because it is assumed that all expenses change in proportion to change in activity. In other words, misleading and erroneous conclusions are avoidable by using contribution margin format, since the cost behavior patterns are disclosed. For example, assume that a firm currently has sales revenue of $100,000 and profit of $10,000. If sales revenue were to drop by 10% to $90,000, a quick conclusion would be that profit would be also declined by 10% to $9,000. However, analyzed using the contribution margin format results in a much more accurate and disturbing result. The 10% reduction in sales revenue resulted in a 10% reduction in contribution margin amounting to $9,000. This carried through to reduce profit by $9,000 since fixed costs did not change. This is an example why it is misleading to think of fixed costs on a per unit basis. Although management cannot ignore fixed costs, it must be recognized that they have behaved differently from variable costs. Let's move on to the activity. Assume that management wants to know the profit from a product that has the following revenue, cost, and volume characteristics. Selling price per case is $20, variable expenses per case $11, fixed expenses associated with the product $50,000, sales volume in class 2,000 cases. First, we need to prepare a contribution margin income statement. The sales revenues is $1 million. Since the selling price per case is $20 and the sales volume is 2,000 cases, and times them together, and the sales revenue is being calculated. Variable cost. The per case of variable expenses is $11 and the cases is 2,000 cases. And the answer is coming out. And the contribution margin is sales revenue minus variable cost. Fixed cost is fixed cost, so it's fixed, so it's $50,000. And the operating profit is contribution margin minus fixed cost. And the answer is $400,000. This is the end of the video. Thanks for your watching.